Welcome to Tutor Sam Academy.
Hi everyone, my name is Sam Akimbode, fondly called Tutor Sam. So welcome to Tutor Sam Academy YouTube channel. Alright, if you are joining us for the first time, do well to like our videos, subscribe to our channel, do well to make comments. As a matter of fact, turn on the notification bell in order to have access to our previous videos and our subsequent videos. Alright, so today we would continue on investment appraisal. Alright, so I could remember in the previous class we had, I did a detailed video on investment appraiser. All right, we talked about accounting rate of return. So let me just give you take you through the previous journey. All right, so in our previous video we talked about the types of investment appraisal. We have certain investment appraisal that are discounted cash flow, all right, so for the discounted cash flow, we have certain examples under where we have the likes of net present value, NPV. We have the second, which is the internal rate of return, internal rate of returns. That is the IRR. And of course, finally, we have profitability index. That's the PI. And of course, some of the times we used to have discounted payback period. Yeah, sometimes. Of course, this is recently introduced, and of course, we're going to solve one or two examples under it. We have the discounted payback period, which is the DPP. All right, so that is for the investment appraisal that has to do with the discounted cash flow. However, we have the investment appraisal that has to do with non-discounted cash flow. I'm going to list them out. So we have, for the non-discounted cash flow, method. For the non-discounted cash flow, the first we have here is the ARR, accounting rate of return. Accounting rate of returns, that's the ARR. And of course, we also have the payback period. So that's the PBP, payback period. So basically, these are the 5 methods we have under investment appraisal. And of course, I could remember very vividly that in our previous class we have dealt with in detail the accounting rate of return. So right today we'll be considering the net present value as one of the methods under the discounted cash flow method, the net present value. All right, so the net present value now. All right, so moving on, the net present value. All right, so for the net present value, we have a few rules for net present value. So now the first rule is this: when the net present value is positive, it means that the company's return is greater than its initial cost of capital. So take note of that. When the NPV is positive, let me write it on the board for you. So when NPV is positive, it means that the company's return is greater than its initial cost of capital. Its initial cost of capital, or initial cost of investment of investment. What does this mean? This means that our net present value tends to be very positive if the company's return, that is the generated profit after the extensive year of investment, is greater than the initial amount of money the company used in the investment. Do you get it now? So that is, the company's return is greater than the company's cost of capital or initial investment. That is how you know that your NPV tends to be profitable, or whenever it is positive. Is that okay? So the second rule, we call this rule 1. So you can call these rules of NPV. So rule 2, when NPV is negative, the company's return is lesser than its initial cost of capital or initial cost of investment. What's the saying? It's telling us that when NPV is negative, the company's initial investment or initial returns rather is lesser than the company's initial investment. So when NPV is negative, it means that the company's returns, the income the company generates, is lesser than the initial investment, that is the cost of capital invested into the business. Those are the rules. So in a simple term, you can say NPV positive equals when returns is greater than initial cost of capital or investment. Are we good? NPV negative when what? Returns is lesser, are we good, than the initial cost of capital or investment. Are we good? All right. You don't pause on.
Observation.
Yeah. So moving on net present value. All right, so I'm going to be sharing with you the formula for net present value. All right, so for net present value, the formula is the present value times the discounted cash flow. The present value times the discounted cash flow. All right, so we have the NPV here giving us present value times. So the discounted cash flow is 1 over 1 plus R, open bracket, all raised by n. Right, so in this equation, R here means rate. That's the discounted rate. So it's always given in percentage. While the n is the number of years. Are we good? All right, so finally, our NPV is derived as summation of all the present value. Are we good? Summation of all the present value, that is the cash flow for the year. Summation of the cash flow or the cash outlay, that is the present value, multiplied by 1 plus the rate, everything all raised by minus number of years. So summation PV times 1 plus R all raised by minus n. Are we good? So now we'll be moving into the calculation. So I'm going to be writing an illustration on the board and we solve the example. All right, so everyone, welcome back. So now to the illustration on net present value. All right, Ebuka Limited is contemplating whether to embark on an investment which requires an initial capital of 25 million. All right, so I've told us in the previous, explanation, that when we are talking about the initial capital, that is talking about the amount of money that was initially invested into the business. Are we together now? So now that it's more like the capital introduced into the business. So the amount of money invested into the business is the initial capital. All right, so by the time we start solving, you do realize that the initial capital would actually fall under the 0 year. So we assume that the business started its operation from the very day the capital was invested. Are we good now? So, but then the profit we begin to earn will be after the year of investment. Are we good now? So it means that our initial capital here is going to start with its year 0, and of course, year 1 will be the year by which we access or make the first profit. Is that okay now? So the initial capital, that is the amount of money initially invested into the business, is 25 million. All right, so they said the project is to last for 4 years with no scrap value. So that is telling us that is the number of years that the investment is able to last for. So for 4 good years with no scrap value. All right, so the following are estimated to be the net cash flow for the lifespan of 4 years. So it means that for the 4 years of terrain of the investment, these are the cash flow, those are the returns that the organization got from the investment. So for year 1, the first return was 8 million naira. So it means that at the end of year 1, they realize a profit of what? 8 million naira. For year 2, they realize a profit, a return of 15 million naira. For year 3, they realized a profit of 12 million naira. And of course, for year 4, they realized a profit of what? 3 million naira. So of course, we have to calculate for the returns, the cash outflow, using the NPV method. So we want to make decision on whether or not to invest in the business. All right, so we want to make a decision for Ebuka Limited to see whether this particular investment is profitable or is not profitable. All right, so move the calculation. All right, so to solve our question, Ebuka Limited, all right, if you look at the question very well, the question told us that Ebuka Limited is contemplating on whether it should embark on a particular project. And of course, the initial cost of investment, the initial capital, is 25 million. Of course, the 25 million is the amount of money Ebuka invested. Are we good? The amount of money invested, all right, so that's going to be what year? That will be year 0. All right, so we assume that is year 0, and which is the amount of 25 million naira. So 25 million naira being the very first amount he invested. So 25 million naira here will be in bracket. Are we good? Which try to explain to us that this 25 million is the amount he invested. So this is not a return, neither is it a profit yet. That was the amount he invested into the business. All right, to move on is our discounted cash flow. Now, if you remember the formula I gave you, I told you to get your NPV. You have PV times DCF, and of course our DCF, which is the discounted cash flow, is actually at the rate of is actually defined as 1/1 plus R all raised to power minus n, or 1 plus R all raised to power minus n. Sorry, this is raised by n. So of course, so for the sake of this question, this is the one we're going to make use of. So you have your 1 plus our R. Now the R here is the rate. So if you look at the question, were we given a particular rate in the question? All right, so the question gave us at the end that we are asked to calculate for the NPV, that is to determine whether or not the project should be undertaken, and the rate here is 10%. So 10%. So of course 10% can also be written as 0.1. Are we good? So 10% can also be written as 0.1. So which means we're having there 1 plus 0.1 raised by n minus our n here. I said it is the number of years. So you trace it down here. What's the number of years we have here? 0 raised by 0. So by the time you do your calculation, you find out that this is 1 plus 0.1, which is 1.1 raised to power minus n. Let's point to the face of our calculator. So we have 1.1 raised to power minus 0. You have your 1. So our answer here is what? 1. So our DCF is what? 1. Are we good? So 25 million times 1, what do you have? You have 25 million. So remember, you are still having this in brackets. You have 25 million. Are you getting it now? So of course, so what do we just did? We just followed the formula that says cash flow times DCF to give you what? Present value. So moving on to the next. Now, if you read the question told us that the spread for the period of 4 years. Spread for the period. So we have for year 1, we have for year 2, year 3, and of course year 4. So for the second year, let's look at the returns generated over time. All right. So for the first year, the cash flow generated was 8 million naira. So for year 1, so the cash flow generated was 8 million naira in the question, 8 million naira. Now, because this is the returns, it doesn't have to be in bracket anymore, because this in bracket means it's the initial amount of money invested. But here is the return, the profit we began to generate from year 1. So, all right, to solve for the discounted cash flow of this, still following the same principle. So you have 1 plus our R still remains 0.1. Are we good? 0.1 all raised to power minus n. What's our n here? 1. So minus 1. So what do we have as a final answer? So we punch the 1.1 raised to power minus 1. So that gives us just approximate to 4 dp. So that gives us 0.9091. 0.9091. So when you multiply 8 million with 0.9091, what does it give you? 0.9091 times 8 million. 8 million. What does that give us? That gives us 7,272,000. 7,272,800. 800. Are we following now? So I think we're moving on. So now, moving on to the next cash outflow. Let's look at the question. Now, this is the first year. For the second year, how much do we have? We have 15 million naira. So it's telling us that for the second year, we have 15 million naira generated. 15 million naira. 15 million naira. So 15 million naira being for the first year, for the second year, we calculate the same DCF for 15 million naira. Following the same principle, we have 1 plus 0.1 all raised to power minus n. What was our n here? 2. What do we have as the value? Please follow suit. So we have 1 plus 0.1 giving you 1.1 all raised to power minus 2. So that gives you 0.8264. 0.8264. So multiply this 0.8264 with your 15 million. What does it give you? 15 million times 0.8264. That gives you 12 million. That gives 12 million 396,000. All right, so that's for year 2. I think we're moving gradually. So now to year 3 now. Year 3, we are giving an investment of 12 million. 12 million. When an investment of 12 million, the returns of 12 million was generated from the investment. So following the same principle for the DCF, we have 1 plus 0.1 all raised to power minus 3. So minus 3 being the number of years. So let's go. So what do we have? 1.1 raised to power minus 3. So we have 0.75131. 0.7513. So when you multiply this with your cash flow for the year, you have 0.7513 times 12 million. That gives you 9,015,600. Are we good? Now, finally, to the final year, year 4. Let's see the amount of returns. For year 4, you have 3 million to be the amount of return. We have 3 million. So let's calculate. Firstly, get your DCF, which is, please don't mind my marker. My marker is fading out already. So to calculate for your DCF, you have 1 plus 0.1 all raised power minus 4. Let's get the DCF for it after calculation. So you have 1.1 all raised power minus 4. All right, so we have 0.6830. 0.6830. So when you multiply 0.6830 with 3 million, what do you have? 3 million times 0.683. Right, so to calculate, we have 3 million times 0.6830. So what do we have? 2,049,000. Yeah. Then your sum total. Now this is the end of the 4th year, and of course we want to derive our net present value, which is called NPV. So which means whatever you get here is your NPV. So like I said, to calculate for our NPV, 3 million, when you add it all together, it gives you 30,733,400. Now remember, I told you how to make decision in NPV, right? I told you when your NPV is positive, it means that your returns, are we together, is greater than the initial investment. So by the time we calculated all our returns from year 1 to year 4, what we had was 30,733,400, which means our return for the 4 years is greater than the initial amount we invested. So you see, our NPV becomes positive. So in your decision making, you make decision for Ebuka Limited, telling him that he can invest. Go ahead with the investment. Why? Because the generated return is greater than the what? Initial investment. So by the time you subtract the total of your returns, which is 30,733,400 from 25 million, let's do that. 25 million, it gives you 5,733,400. So this 5,733,400 is what we call the NPV, the net present value. Are we good? So decision. Ebuka Limited can invest because the returns, let me just dictate. I don't have ink in my marker anymore. So because the generated investment or returns is greater than the initial investment. Are we good now? So that is that about NPV, net present value. So I believe that with this explanation, whenever you come across any question on NPV, of course you should be able to solve them. Of course, in our subsequent videos, I'll be treating payback period, and of course I'll be treating a question on IRR. So after all well done and solved, so I have a few questions from I Can Pass questions that I'll be solving for you as well. Please stay tuned. Subscribe to our YouTube channel, like, comment, and turn on the notification bell. Follow Tutor Sam, and God bless you. Thank you so much.
Thank you for watching. Stay tuned.